Good evening, everyone. We're very pleased to welcome you this evening to our 2023 Information Seminar. We are delighted to see that so many of you joined us on what is also the 75th anniversary of International Credit Union Day, the intention of which is to reflect upon the credit union movement's history globally, promote its achievements, recognise hard work, and share member experiences.
The unique combination of credit union directors, board oversight committee members, other volunteers, management and staff, along with credit union members, are key differentiating features contributing to the success, longevity and trust by credit union members and the wider public in credit unions in Ireland. I note also the annual CXI Customer Experience Report results that were published on the 2nd of October last, with credit unions topping the ranking again in terms of customer experience. Indeed, the only brand to have maintained a presence since the survey started in 2015 and retaining the #1 spot for a 9th year. It's worth calling out that the report notes that key to this is credit union staff who treat members with the highest respect, with the example referenced of when someone joins a credit union, they're not simply joining a banking service, rather they join a caring group fixated with providing relevant services to people they know in local communities. Also noted that staff listen to understand their members' needs around life stages and customise solutions accordingly. So well done to all of you. Your commitment in delivering in your respective roles is a key enabler in ensuring that credit unions continue to develop and maintain sustainable businesses, serving your members' needs while ensuring protection of their savings. Thank you for your continued cooperation with us here in the Registry of Credit Unions over the past year. We also recognise that this is a particularly busy time at your credit unions, given the 30th of September year end. Our staff here in the registry are committed to working with you over the coming period in order to ensure both an efficient and also a professional approach to the 2023 year end. Before I introduce the topics for this evening, I just want to say a few words on challenges and opportunities for credit unions and mitigating the risks arising. Against a background of continued uncertainty in the global economic outlook, including higher interest rates, inflation, and weaker growth prospects, together with change in the delivery of financial services, i.e. innovation, digitalisation, outsourcing, as well as climate change risk. As credit union boards and management, you need to be cognizant of the impact of these on your business and how to manage and respond to such changes. Some examples of impacts arising include the effect of higher interest rates on demand for credit, with potential greater risk aversion to borrowing by households and businesses, potential for increase in arrears arising from the impact on members' incomes from both higher interest rates and cost of living increases, and the impact of interest rates on investment portfolios, which can be positive as well as negative, particularly perhaps on the market value of bonds that may have been purchased during a period of low interest rates. In terms of response by credit unions, continuing to focus on maintaining financial resilience through ensuring adequate reserves and liquidity to withstand unexpected losses and other stress scenarios is critical to being prepared for and able to withstand potential shocks, as is effectively managing operational resilience, ensuring a strong overall control framework, which includes identifying and mitigating IT and cybersecurity risks, as well as ensuring that effective risk management and business continuity processes are in place, including for key outsourced activities. Credit unions fulfil an important role in the Irish financial landscape. That landscape continues to change at pace, and how you deliver products and services to meet your members' needs will be a critical factor in your future sustainability. There are opportunities ahead, including from the new credit union bill that was before the Oireachtas yesterday, which proposed legislation we very much welcome and will support credit unions through updated regulations and guidance as appropriate. We will continue to regulate and supervise credit unions in an assertive, risk-based and proportionate manner, reflecting nature, scale and complexity, with the overall objective of safeguarding credit union members' interests in accordance with our statutory mandate. In terms of context for our approach to engagement with credit unions and sector stakeholders, the Central Bank's 2022 to 2026 strategy includes 4 connected themes of safeguarding, future-focused, transforming, and open and engaged. The registry is committed to being open and engaged with credit unions and sector stakeholders, and this annual information seminar is one part of how we deliver on this theme. Other aspects of our engagement approach include our regular engagements with individual credit unions, with the representative bodies, CUDA, CUMA, ILCU and NSF, the Department of Finance, and the Minister of State with responsibility for financial services, credit unions and insurance, as well as CUAC and other sector stakeholders. And also our other key part of engagement is through our publications, some of which include the Financial Conditions of Credit Union Statistical Series, our Credit Union newsletter, and circulars, all of which are intended to support and inform you on a range of credit union policy and supervisory areas. So moving now to the agenda for this evening, a number of staff from Central Bank will present, namely Katie Philpott from our Consumer Policy and Research Division, and here in the registry, David Lynch, Paul Cullen, James McCauley and Colm Henry. We have a wide range of topics, as you can see there on the agenda, which is on the screen. Firstly, extension of the Minimum Competency Code to in-scope credit union activities. Secondly, year-end 2023 and a selection of supervisory topics covering systems of control and cybersecurity, liquidity management, operational resilience and outsourcing. Thirdly, we're going to have a restructuring update. And then fourthly, policy snapshots covering updates on exempt services, lending review, and member business current accounts and member personal current account services. The presentations will then be followed by a question and answer session, and that will be facilitated by David Keelty and Eamon Clark. And in terms of any questions you have, they may be inserted in the chat box. The full session, including the questions and answers, will take about an hour and 15 minutes. So we aim to finish up by about 6:30 p.m. As in previous years, we are recording the presentations from this evening, and the recording will be made available on our website in due course. Copies of each of the presentations will also be available on our website. And once available, a link will be provided to your credit union. Also, importantly, if you do have any questions arising after this evening on any of the topics covered, please contact our office by email and we will respond to you directly. So at this stage now, I will hand over to Katie Philpott, who will provide the first of this evening's presentations on the topic of the Minimum Competency Code. Thank you.
Thanks very much, Elaine. As Elena said, my name is Katie Philpott. I'm the manager of the Insurance and Intermediaries team in the Central Bank's Consumer Policy and Research Division. The team is also responsible for the Minimum Competency Code. Jennifer, could you move to the next slide, please? To provide you with some background, the Minimum Competency Standards aim to ensure that consumers, or in the case of credit unions, members, obtain a minimum acceptable level of competence from individuals acting for or on behalf of credit unions when providing advice and information and associated activities related to retail financial products. The standards are made up of 2 components. The first is the Minimum Competency Code. The code applies to individuals in controlled functions when they are performing certain activities. I'll come back to controlled functions later in the presentation. The second part is the minimum competency regulations. The regulations apply to firms and sets out their obligations to ensure that their employees are compliant with the code. For ease of reference throughout the presentation, I'm just going to refer to the MCC throughout, unless there's a need to differentiate between the two. So back in 2016, we first consulted on a proposal to extend the MCC to credit unions. Following consideration of the responses that we received at that time, we decided to take it away. We thought it needed further consideration to see what the potential impact of these proposals would be on credit unions and their staff. And following this review, a further consultation was published in 2022, which outlined our proposal to apply the MCC to credit union services. Jennifer, could I move to the next slide, please? So that consultation, which was consultation paper CP 147, you'll see the cover page there on the screen. We received 13 submissions to this consultation. 9 were from credit unions themselves and 4 were from representative bodies. In line with the central bank's policy in respect of public consultations, all submissions have now been published in full on our website. And in the responses, if you look at them, you'll see that there's broad support for the proposal. There were some areas where clarification was sought, and one of them was in relation to the role of volunteers. In the central bank, we acknowledge the important role that volunteers play in the credit union sector, but the MCC applies to individuals undertaking specific activities and services rather than the titles or roles that those individuals might hold. So if you're an individual that is in scope of the MCC, you should be appropriately qualified regardless of whether you are a volunteer or an employee. The same applies to board members. There was also some feedback on how these changes would impact on the staff of the credit unions. We acknowledge that this may be a burden for some or maybe a difficulty for some, but we understand that the majority of credit union employees already hold a relevant qualification. And we've also listened in the case of the timeline, and some responses suggested that the timeframe we had proposed was a little tight. So we've opted for a 1-year transition period, followed by 4 years to obtain the qualification. So that's 5 years in total. If you move to the next slide then, please, Jennifer. Thank you. The MCC, as some of you will already know, is very closely linked to our fitness and probity regime. The MCC applies to persons in controlled functions, as I mentioned previously, undertaking specific activities that are called out in the MCC. And as you'll know, credit unions are subject to a tailored fitness and probity regime. Therefore, in order to bring the additional credit union activities within scope of the MCC, we were required to amend the control functions in the credit union fitness and probity regime. This meant introducing 6 new control functions in addition to the existing 2 that already apply for credit unions. These are summarised here in the slide. I have to be careful to say that these are a summary of them. There's more detailed information in the statutory instrument or on our website. Jennifer, can we have the next slide then, please? So I'm sure you're all asking yourselves, what does this mean for you? Well, in a nutshell, anyone undertaking any credit union controlled functions and those activities that are specified in the MCC must hold a recognised qualification. When the legislation comes into force on the 1st of October 2024, if you do not hold the recognised qualification, you can still continue in your current role, but you should be working towards obtaining a required qualification by the 1st of October 2028 at the latest. If you want to know what are the recognised qualifications for your particular roles and responsibilities, you'll find an up-to-date list on the Central Bank's website and in the recently published addendum to the MCC that's also on our website. This list includes credit union specific qualifications which have not yet been recognised because credit union activities don't come currently within scope, but these will be recognised with effect from 1 October 2024. We've included these qualifications now so that if you hold any of these qualifications, you'll have the comfort in knowing that you're going to be compliant when the time comes. Or if you need to obtain a relevant qualification, you can look at the different options that are available to you. And just to be clear, you don't need to hold a credit union qualification for any individual category. That's one option. However, for example, you could have the qualified financial advisor or accredited financial practitioner if your role falls into savings and investment category, or you could actually hold both if you do enjoy studying. You'll also be required to undertake continuing professional development CPD of 15 hours each year at a minimum. One of these hours must relate to ethics, and this is consistent for anyone who's subject to the MCC, regardless of what sector they work in. CPD can be obtained in a number of ways. For example, by attending lectures, seminars, training courses, conferences, etc. However, it must be relevant to your role or activities, and it must be accredited by the provider of a recognised qualification, such as the National College of Ireland. And in addition, the maximum CPD you can do is 8 hours in any one day and 4 hours in any one topic. So Jennifer, if you can move to the next slide then, please. So the time frame, just to reiterate, the new requirements come into force on the 1st of October 2024. Relevant credit union staff will have until 1 October 2028 to obtain the relevant qualification, and the changes in the fitness and probity regime for credit unions come into effect on the 1st of October 2024 as well. So if we just move to the last slide then, Jennifer, please. On this slide, you'll see a list of further information with links where you can find them, and I hope you find those useful. Thank you.
Good evening, Jennifer. Can you hear me?
We can indeed, David.
Good evening, everybody. The 2023 financial year end and related matters circular was issued to all credit unions on the 11th of September 2023, which you should have all seen by now. A copy of the circular was also emailed to the external auditors of credit unions. I would like to touch on the following key points outlined in the year-end circular: the economic environment and outlook that we currently face, the various impairment reviews required before drafting your 2023 financial statements, the registry's expectations in relation to distributions and prudent reserve management, and draft financial statements, statutory notifications to the Central Bank of Ireland. My colleague Paul will subsequently present on other supervisory topics which were also outlined in the year-end circular. Next slide, please, Jennifer. So some context in relation to our economic environment, the challenged economic environment. As credit unions approach the 30th of September 2023 year-end, there are challenges in the economic environment. These challenges are underlined in recent central bank publications. While the June 2023 quarterly bulletin highlights that growth in the domestic economy for 2023 is expected to be slightly stronger than previously anticipated, economic uncertainty remains high, with the growth forecast contingent on various factors, including geopolitical tensions not escalating and energy prices continuing on their downward trajectory. Further to this, the Central Bank's June Financial Stability Review outlines the risks facing the Irish macro-financial system, including that the global economy is subject to downside risks stemming from high inflation, further tightening of financial conditions, and geopolitical fragmentation. The Irish economy remains vulnerable to the risk of persistently high inflation and higher interest rates that could lead to slower growth and expose vulnerabilities. Credit unions should give consideration to the economic environment and outlook as they plan their approach to year-end, and as they seek to address sustainability challenges that many credit unions face. Accordingly, for all credit union boards, a key aspect of the 2023 year-end process should be an informed identification and consideration of key risks and appropriate mitigation and management of such risks. It remains fundamental that a prudent approach is maintained in respect of all aspects of a credit union's business to underpin the overall financial resilience of the credit union. The maintenance of strong reserves is key to underpinning member confidence, particularly in the uncertain macro financial environment where sustainability challenges continue. Impairment reviews. So, loan provisioning. The overarching guidance which continues to inform the credit union's approach to assessing the level of required loan loss provisions on an ongoing basis is the provisioning guidelines issued in April 2018. The provisioning guidelines are available on the Central Bank's website. Credit unions should consider how circumstances arising from the evolving economic environment may affect the likelihood of loss events occurring in their loan portfolios and apply loan loss provisions in a prudent manner. It is our expectation that boards will take a conservative approach to the measurement and recognition of loan loss provisions. Financial Reporting Standard 102, FRS 102, requires an incurred loss approach to calculation of bad debt provisions on loans. And that all loans are reviewed for objective evidence of impairment. As outlined in my first slide, there are challenges to the global and domestic economy, heightened inflationary pressures, and increased uncertainty in the medium term, all of which could impact on loan losses and provisioning requirements. Credit unions should be mindful of this when assessing the adequacy of their loan loss provisions at year end. Moving on to the impairment reviews on fixed assets. Where credit unions are using a value in use approach, that is, where the market value of the fixed assets are lower than the carrying value, a review of the appropriateness of the underlying assumptions used in deriving the expected cash flows should be undertaken. The review should ensure that the assumptions are reasonable and supportable, particularly in the current economic environment, as I outlined in my first slide. The review of investments is another critical part of the year-end process. The accounting policy adopted by the Board of Directors of a credit union for the valuation of investments should comply with the relevant sections of the Credit Union Act 1997. Section 110 of the Credit Union Act 1997 requires that the amount of any item in the financial statements shall be determined on a prudent basis, and in particular that all liabilities and losses which have arisen or are likely to arise in the financial year to which the financial statements relate or to a previous financial year shall be taken into account. Full and detailed disclosure of the accounting policy adopted for the valuation of investments should be included in the annual financial statements. Next slide, please, Jennifer. So, credit union distributions and the need for prudent reserve management. As I outlined earlier, there continues to be elevated levels of risk and uncertainty regarding the economic outlook with a challenging economic environment. Building and maintaining adequate reserves, including adequate operational risk reserves, remains key to ensuring credit union financial stability and resilience. The Registry of Credit Unions expect all credit unions to continue to take a prudent approach to distributions in the context of reserve management. Any credit unions considering proposing a distribution are expected to contact their supervisor in the registry at an early stage, clearly outlining the rationale for proposing this course of action, taking account of liquidity, underlying surpluses, operational resilience, and the need to demonstrate prudent, forward-looking capital reserve management in the current economic environment. Credit unions should give due consideration to a multiple-year, forward-looking strategy reflecting their specific reserve management policy. The Board of Directors need to carefully consider the adequacy of loan provisions, other asset impairments, and prudent reserve management in 2023, given the current uncertain economic outlook and significant related challenges. Maintaining and building adequate levels of reserves, including operational risk reserves, remains key to ensuring credit union financial stability and resilience. The next slide, please. The draft financial statements return is required to be submitted through the Central Bank of Ireland portal login in advance of their finalisation. Supervisors may follow up directly with individual credit unions on any issues arising and/or to request a PDF version of the draft financial statements. Any questions or issues with any of the submissions, please contact your supervisor. In relation to the statutory notifications, the year-end circular includes an appendix. This appendix details the timelines for statutory notifications returns to be submitted to the Central Bank of Ireland. That completes my presentation. I will now pass you over to my colleague Paul.
Good evening. As already mentioned, the 2023 financial year-end and related matters circular also highlighted a number of supervisory topics. And whilst not an exhaustive list of topics that continue to receive close supervisory attention, I will now highlight central bank expectations in relation to the following: systems of control and cybersecurity, liquidity management and monitoring, and operational resilience, including outsourcing. So in relation to systems of control and cybersecurity, the year-end is an opportunity for each credit union to review its risk management and internal control environment, policies and procedures as necessary. In this regard, boards and management of credit unions are reminded of their responsibilities for establishing an effective internal control framework and for monitoring systems and controls on an ongoing basis. The infographic on this slide includes examples of internal control measures, including effective segregation of duties and cash management processes, proper accounting records, and secure remote working arrangements. As you will be aware, there is a continuing upward trend in IT and cybersecurity incidents reported by organisations domestically and internationally, for example the HSE ransomware attack in May 2021. As such, credit unions need to be increasingly vigilant in relation to potential vulnerabilities in their IT systems. IT and cybersecurity controls should be an integral part of the overall systems of control framework, including data security and business continuity arrangements. Credit unions must ensure that they have strong and robust systems of control in place to maintain ongoing compliance with Section 76G of the 1997 Act in relation to information systems. It is the responsibility of credit unions to understand the range of specific IT-related risks which they are exposed to, and to ensure that these risks are appropriately mitigated and managed. Next slide, please, there. In relation to liquidity management, you are aware that credit unions are required to maintain a proportion of total assets in liquid form to meet obligations as they arise. As credit unions continue to increase the level of loans which they have outstanding for longer periods, their liquidity requirements are increasing. And some credit unions have advised the registry of potential liquidity-related challenges over recent months. Credit unions must have regard to the composition and maturity of assets and liabilities in the ongoing management of liquid assets to ensure that adequate liquid assets are maintained in line with Regulation 8 of the 2016 regulations. In adherence with Regulation 9, credit unions are reminded to continuously monitor their liquidity position to enable the credit union to meet its liabilities as they arise. The Board approved liquidity management policy, as required under Section 55 of the 1997 Act, must be sufficiently detailed in relation to the liquidity management and monitoring arrangements in place, and the liquidity policy should also address the minimum requirements outlined in the liquidity chapter of the Credit Union Handbook. Given that investments and loans are funded primarily by on-demand member savings, it is important that credit unions maintain a prudent approach in relation to lending, investments and liquidity. Credit unions should take a proactive approach to their overall asset and liability management, in order to ensure their ongoing compliance with legislative and regulatory requirements. Next slide, please, Jen. In relation to operational resilience, credit unions are reminded that the Central Bank's cross-industry guidance on operational resilience issued in December 2021, and credit unions are expected to be in a position to evidence application of the guidance within a 2-year period. The guidance defines operational resilience as the ability of a credit union and the financial services sector as a whole to identify and prepare for, respond and adapt to, recover and learn from an operational disruption. The COVID-19 pandemic has put firms' operational resilience to the test and highlighted the importance of being more operationally resilient. The Registry of Credit Unions acknowledges that credit unions demonstrated operational resilience during the COVID-19 pandemic environment and continue to serve their members' needs and provide a critical service in local communities under challenging operational conditions. The purpose of the guidance on operational resilience is to communicate to the boards and management of credit unions the Central Bank's expectations with respect to the management of operational resilience, to emphasise board and management responsibilities when considering operational resilience as part of their risk management and investment decisions, and to articulate the requirement for boards and management to take appropriate action to ensure that their credit unions' operational resilience frameworks are well designed and operating effectively. An article on operational resilience was also included in issue 18 of the Credit Union News publication from May 2023. The Central Bank expects credit unions to actively and promptly address operational resilience vulnerabilities and to be in a position to evidence actions and plans to apply the guidance by December 2023, taking into account the nature, scale and complexity of the credit union's business. Next slide, please, Jen. In relation to outsourcing, credit unions are expected to have effective governance, risk management and business continuity processes in place to mitigate potential risks of financial instability and consumer detriment. This also includes having appropriate outsourcing arrangements in place. Outsourcing requirements are set out in Section 76J of the 1997 Act. Outsourcing arrangements including the outsourcing of key activities such as core IT activities create a dependency on a third party, which has the potential to influence the operational resilience of credit unions. A credit union must exercise due skill, care and diligence when engaging in outsourced activities with a service provider. With many credit unions operating branch networks, this increased reliance on IT and outsourcing also increases operational risk for the credit unions. The cross-industry guidance on outsourcing, which was published in December 2021, was introduced to supplement existing sectoral legislation, regulations and guidelines on outsourcing by setting out the Central Bank's expectations of good practice for the effective management of outsourcing risk. At all times when outsourcing activities, a credit union must ensure that the outsourced activity is not disruptive to its overall business operations. In cases where credit unions have obtained approval to provide additional services to members, they should also be cognizant of how they will meet the conditions attached, including those on outsourcing and continuity of services. Credit unions are expected to establish and maintain an outsourcing register of all outsourcing arrangements to assist centralised oversight and management of related risks appropriately. An article on outsourcing registers was included in issue 17 of the Credit Union News publication from October 2022. An outsourcing register template is available on the Central Bank website to assist credit unions in the oversight and management of related risks. You may find the guidance helpful in the population of the outsourcing register template. I will now pass you over to my colleague James McCauley.
Thanks, Paul. Good evening, everyone. My name is James McCauley, and I work on the intervention and restructuring team within the Registry of Credit Unions. This evening, I'm going to be giving a brief overview of credit union restructuring that has taken place over the past 2 years in 2022 and 2023, and looking at some of the kind of profile of restructuring in more recent years as well. I'll also be providing some insights into the current trends that we within the registry are experiencing through the restructuring process, both in transferor and transferee credit unions. And finally, I'm going to take a look at some of the benefits that have been enabled by restructuring to date. So Jennifer, if I can just jump to my first slide there, please. So to start with, I just want to provide a brief overview of the sector profile, looking at where we are now in 2023 with 192 trading credit unions as of today's date. So far this year has been another active year for restructuring activity in the credit union sector, and we continue to see that restructuring contributes to the overall transformation of the sector, and that aligns to one of our 4 strategic themes within the central bank that Elaine alluded to earlier as part of our opening comments, that transformation. So just looking at that restructuring overview, I suppose firstly, just to look at the profile of restructuring during 2023 in the year to date, RCU have facilitated the completion of 11 transfers of engagement, or TOEs. These TOEs have involved transferees with varying asset sizes, anywhere ranging from just under 20 million to over 350 million in asset size, and transferor credit unions with their total asset sizes ranging from under 10 million to more than 100 million. So I suppose the obvious question there is, what does that tell us? And that variance in asset size tells us that the variance here is obviously quite broad, and this demonstrates the range of both scale and complexity that we within the registry continue to experience in both our transferees and transferor credit unions that engage in the transfer process. There's a complexity of issues throughout these transfers in relation to financial issues, operational issues, governance issues, strategic issues, and I'll cover and touch on some of those in the next slide when I look at some of the factors and kind of motivators behind transfers. But yeah, it's obviously fair to say that in terms of those issues that we experience, given the variance in transferees and transferors, that there's quite a broad range complexity. Keeping with the actual profile of restructuring. So in the graphic at the bottom of the slide here on screen, you can see a timeline for restructuring within the sector, starting back in 2019 and up to the year to date in 2023. You'll note when you look that overall TOE projects have been quite stable, with 12 completing back in 2019, moving steadily across to just 9 completing in 2022, as I mentioned, 11 in the year to date in 2023. I should add also, we have a number of additional projects in our active TOE pipeline that are due for completion in the coming months. Now, whilst the number of TOE projects completed in these years has remained stable, we have seen, as I mentioned already, quite a variance in relation to the reasons and the motivating factors for these TOEs, with items like governance issues, financial performance, strategic challenges, and kind of operational staffing issues or challenges giving rise to credit unions' own decision to enter into a TOE process. I'll explore some of these factors a little bit more when I come to discuss those trends that we see in restructuring activity. I just want to turn my attention now to the map infographic on the right-hand side of the slide there. So looking at that map infographic on the right, you can see an updated overview of those counties that have undergone more significant restructuring activity. Also, I should point out here, just a note for reference, whilst I've previously looked at the 5-year profile in the bottom of the slide and the information at the bottom, the map on the right-hand side compares the position from 2008 up until the present day. So from 2008, the number of credit unions within the sector has reduced from 419 to the current figure you see on screen of 192 as of today's date, and that reduction represents approximately 55% of a reduction overall in the number of trading credit unions from 2008 until today's date. So as you can also see in the map at this stage, every county has undergone restructuring activity, either in the capacity of a transferor credit union or a transferee credit union as part of a TOE process. And in some counties, up to 75% of credit unions have undergone restructuring versus the position that we started at back in 2008. So overall, 16 of our 26 counties reported on the map have experienced restructuring of 50% or more. So the profile of restructuring across the majority of counties is fairly significant. Jennifer, I might move on to slide 2, please. So just to move on and look at some of the restructuring trends. So in considering some of the trends that we've experienced as part of TOE projects in the past 12 or 18 months, I plan to look at these under 3 separate headings. Firstly, some of the factors we've observed that have brought transferee and transferor credit unions into TOE projects. Secondly, emphasising some of the supports that are available and offered to credit unions by ourselves within the Registry of Credit Unions in relation to restructuring. And lastly, looking at some of the benefits that restructuring has provided to credit unions who have entered into and successfully completed TOE projects. So turning firstly to the factors which are motivating credit unions to consider restructuring, this obviously differs from credit union to credit union. But one of the trends we've experienced in recent TOE proposals is a more strategic emphasis to proposals that are coming from the credit unions themselves. So what does that mean? I suppose firstly, looking at the longer term strategic considerations. One of the factors we see here that we're encouraged to see is examples of strong, well-positioned credit unions looking to use restructuring as a strategic enabler, if you like, for their membership. And in some cases, this has included plans to restructure in order to better position a credit union to apply for and offer additional member services or additional lending capacity with an increased scale to their own members in the future. These longer term strategic considerations have also seen examples of some credit unions looking at improved online and mobile service offerings to the members as a motivating factor to enter into a TOE process within their credit union. The other point just to mention here is economies of scale. So as credit unions themselves continue to monitor their own cost base on an ongoing basis, we see examples whereby improved economies of scale, elimination of duplicate costs, and restructuring proposals are offering a more efficient and refined operating model. That becomes a factor in how credit unions are considering the overall restructuring process. So when the costs and benefits of each TOE proposal are considered by the credit unions themselves, this becomes quite a significant motivating factor in the restructuring process. The third point just to mention here is that improved operational capability as a factor. Again, it's one of the more interesting motivating factors that we've noted is this potential to improve operational capabilities, be that through greater availability of resources at an operational level or through an enhanced operational control framework in a larger, more established credit union where they act as transferee. So one example we experienced in a recent TOE was a case where a credit union itself was aware of a series of its own deficiencies and weaknesses in terms of its systems and controls in its own operating control environment. These issues had actually previously been identified by the credit union's own assurance functions, including its internal audit and risk management function. And the credit union in this case assessed its own ability to remedy these issues on a standalone basis. And following some consideration at board level, they made the decision themselves to enter into a TOE process in order to more efficiently remediate the risks that they had identified. Another interesting recurring factor we note in recent transfers of engagement is the potential for additional volunteer opportunities or addressing recruitment constraints at board and committee level in some credit unions. There's potential access to a large common bond and a wider pool of members and volunteers that has been cited by credit unions themselves as a motivating factor in why they're considering restructuring. Turning now to some of the supports that the registry ourselves has made available to credit unions as part of the TOE proposal. Obviously, it should be noted that TOEs are a voluntary process. They remain open to any credit union. Our team within the registry has resources available to offer support and answer any questions that boards or managers might have in relation to the process, in relation to the workload or the timelines involved. But just, I suppose, on the first point in terms of expertise, having engaged with credit unions on a significant number of restructuring proposals with, as I mentioned already, varying degrees of complexity, there's quite significant and valuable expertise within the registry in relation to the restructuring process, how the process works, the timelines involved, and any, probably more importantly, more valuable, any potential considerations and risks that you might need to be mindful of at each stage. We can provide kind of insight and guidance in respect of that when we engage with credit unions. And just touching on that guidance, in addition, the registry has produced very helpful guidance on the TOE process, the related stages, the requirements, and some useful templates which credit unions may wish to consider. That's available on our website. Equally, credit unions are able to directly contact their own RCU supervisors or supervisors within the INR team if they have any additional specific queries in relation to restructuring, and we can offer assistance in relation to those kind of matters. So in conclusion, I just want to touch and briefly discuss some of the benefits of restructuring and what trends we've experienced in recent years. So firstly, in terms of addressing financial viability concerns. One of the primary benefits we've noted through the restructuring process to date is the potential to address financial or viability risks in a credit union. A TOE, or a transfer with a more financially stable credit union, provides a more sustainable, longer-term presence for a credit union that might be experiencing viability or sustainability challenges. There's benefit on both sides here, as the transferee credit union gains the ability to serve a broader membership in an enlarged common bond, and the presence of the credit union is preserved within both locations for a longer period than might have been possible on a standalone basis, perhaps. Just to move on and touch on the benefit in terms of weaknesses in governance frameworks. Another one of the benefits we've noticed today is the potential to address these weaknesses in governance frameworks in some credit unions, where through issues arising from, let's say, overall fatigue or succession difficulties. One example we experienced recently had challenges in a transferor credit union in respect of some key board and management positions that were approaching retirement. And in the absence of a suitable succession plan or the availability of any individuals to fill those roles, the credit union themselves chose to bring forward a proposal to engage in a TOE with a neighbouring, more established credit union, which had a well-resourced management team and the capacity to take on the project with transfer, and they saw that themselves as one of the key benefits. In terms of weaknesses in relation to operational controls, I spoke above about the potential benefit that some credit unions derive from restructuring, whereby the TOE may address weaknesses in the governance framework. Another area where we see benefit is in the potential to address weaknesses in relation to operational controls, where some credit unions may not have the ability or capacity to address known weaknesses in their own operational control framework. A TOE can offer a suitable solution to overlay a more enhanced or perhaps established operational control environment with the associated resources and knowledge required as part of a TOE. This is particularly more prevalent where we engage with smaller credit unions, perhaps transferors, excuse me. And lastly, just a point I touched on above, also just a transfer of engagements to TOE as a strategic enabler. And this is perhaps the most important point to finish on. What I mentioned earlier, that we were encouraged to see strong, well-positioned credit unions looking to use restructuring as a strategic enabler for their own membership. This remains for us as one of the key benefits, and for credit unions also. Key benefits that is realised through the restructuring process when credit unions themselves place members at the centre of the proposal for a business case and consider what benefits they stand to gain, the members, from completing a TOE to strengthen their own strategic objectives. So just to finish, I suppose, given the time of year, given what David and Paul have been talking about, as you're all aware, you're in the midst of the year-end process looking at financial performance for 2023. We would just remind and encourage any credit union that's considering potential restructuring activity to make contact with ourselves. My own contact details there on screen. If anybody wishes to contact me, my direct dial is there. I'll just finish up and say thanks and hand it over to my colleague, Colm Henry.
James, and good afternoon, everybody. My name is Colm Henry, and I work on the Policy Assurance and Regulatory Approvals team here in the Registry of Credit Unions. At this point and over the next 10 to 15 minutes, I'll provide you with some updates in relation to some of the registry's recent and current policy-related work, which I hope will be of particular interest to you at this time. While there are, of course, other important policy developments underway at the moment for credit unions, in particular the changes proposed to the Credit Union Act 1997 under the Credit Union Amendment Bill 2022, I'll be providing updates this afternoon on the Credit Union Exempt Services, our review of credit union lending, further to changes we introduced to the credit union lending framework back in January 2020, recent changes to Member Personal Current Account Services, or MPCAS, conditions of approval, which extended MPCAS approvals to the provision of MPCAS equivalent services to relevant members, including business members. So following my updates, you should be aware of the Central Bank's expected timelines to finalise its changes to the credit union regulations, or the 2016 regulations, our work on credit union lending and our expected timelines in that regard, and the recent changes to MPCAS and the supports that are available to credit unions who may wish to commence making current account services available to businesses and other relevant members. So at this point, we will turn to credit union exempt services. And by way of a recap on this topic, following a mainly technical review of the credit union exempt services regulations, the Central Bank published consultation paper 148 in January 2022 for a 3-month consultation period. For anyone not particularly familiar with the meaning of exempt services, I should say that these are services that are essentially those which have been prescribed by the Central Bank as being exempted from the additional services provisions of the Credit Union Act 1997. In other words, credit unions do not require an additional services approval from the Central Bank in order to provide exempt services. And we prescribe those in our 2016 credit union regulations. In undertaking this review, our overarching goal was to ensure that the scope and parameters of the prescribed exempt services and the applicable conditions are clear, appropriate, and reflect the current financial services landscape within which credit unions operate. As part of our review of exempt services, we considered a number of factors, including the Central Bank's statutory mandate, the broader legal and regulatory framework within which credit unions operate, the current framework for the provision of exempt services and additional services, sector engagements on credit union services and business model development, and also recent trends in the provision of exempt services by credit unions. Following our review, consultation paper 148 or CP 148 outlined proposed changes to our 2016 credit union regulations, including the exempt services schedule of the regulations in the following areas and as set out on the slide. Technical drafting changes to the exempt services schedule, technical drafting changes to Regulation 2, which relates to interpretation, and Regulation 48, which relates to performing services. Changes to the conditions which must be fulfilled in order that credit unions may provide certain services as exempt, and a broadening of the intermediation services that credit unions may provide as exempt. The Central Bank has received 8 submissions to CP 148 and we have considered these, and we are now working towards the finalisation of the changes to the 2016 regulations. Turning to our planned next steps and timelines for exempt services and publishing associated amending regulations, we plan to undertake targeted consultation with sector stakeholders in Q4 this year on aspects of the feedback that we received through CP 148. This will then be followed by the statutory consultation on amending regulations in accordance with the requirements under the Credit Union Act 1997 and the publication of a feedback statement and final amending regulations. Just to take a slight sidestep then, and separate to exempt services, I would like to also mention that as part of the upcoming amending regulations to give effect to the exempt services changes, we plan to include a technical amendment to the definitions of approved housing body and Tier 3 approved housing body contained in the 2016 regulations. And that's to reflect developments in 2019 under legislation that relating to the registration and regulation of approved housing bodies. We previously flagged in a letter sent to credit unions back in April this year that we would formally address the matter through updates to those definitions in the 2016 regulations at the earliest juncture. I'll turn to the next slide, please. And next, I'll provide an update on our review of credit union lending. By way of background on this topic, in 2018, the Central Bank published consultation paper 125, which consulted on potential changes to the lending framework for credit unions, with our feedback statement on CP 125, including the resulting final draft amending regulations, that is amending our 2016 credit union regulations published in November 2019. Those amending regulations were made and applied from the 1st of January 2020. In our feedback on CP 125, we outlined our intention to perform and publish an analysis of credit union sector lending 3 years post-commencement of the amendment to the lending framework, in order to assess and analyse the actual impact which the changes to the lending regulations have, and to inform any decisions on the need for future change. The Central Bank's review in this regard is now underway. As set out on the slide, and as part of the review, we plan to analyse relevant lending data reported by credit unions since the commencement of the amending regulations, and to undertake focused bilateral sector stakeholder engagement in order to gather feedback on the impact of the 2020 changes. On timelines for this review, the Central Bank is targeting completion of it and publication of our analysis in Q1 2024. Finally, looking to the third policy-related update that I'll provide this evening, I'll now address the recent changes we made to Member Personal Current Account Services, or MPCAS, conditions of approval. To explain the background on this topic, over the course of 2021 and 2022, a number of credit union sector stakeholders engaged with us in the registry about extending the existing MPCAS suite of additional services to allow credit unions who wish to provide current account services to business members to do so. On the 12th of June this year, we issued a minded to vary conditions letter to 80 MPCAS approved credit unions. The Central Bank received and responded to 2 submissions, one that was made on behalf of 79 MPCAS approved credit unions and a further submission received from an individual credit union. Following this engagement, on the 27th of September, the Central Bank issued final variation letters to MPCAS approved credit unions, notifying them of the final amended MPCAS conditions of approval. So what are the changes? Subject to conditions, the changes introduced via a new Condition 18 allow MPCAS approved credit unions, where they choose to do so, to provide MPCAS equivalent services to relevant members. And in this regard, relevant members are a micro, small or medium-sized enterprise, which we might refer to as a business, a charity, a club or a society. In addition, the changes made incorporated some technical changes to Condition 5, which relates to overdraft interest, as well as Condition 16, which is a condition relating to notifications in respect of major difficulties. On the next slide, I'll address the MPCAS conditions of approval relating to the submission of notifications and attestations to the registry, and the support available to any credit unions wishing to make notifications and attestations to us. As part of an MPCAS approval, in particular the provision of personal current account services, an MPCAS approved credit union must comply with, among other conditions, conditions 1 and 2, which relate to the provision of a confirmation or attestation to the Central Bank, where the credit union confirms to the Central Bank's satisfaction that it has met and implemented the Central Bank's MPCAS risk management expectations, and a notification to the Central Bank of the credit union's operational readiness to provide MPCAS at least 1 month before it intends making those services available to members. Similarly, as part of the new Condition 18, in order to provide MBCAS, or Member Business Current Account Services, an MPCAS approved credit union must also comply with a condition relating to the provision of a notification and confirmation as set out in an MBCAS notification form as published by the Central Bank on our website. To assist relevant credit unions wishing to submit notifications and attestations, the Central Bank has published a new guide called the MPCAS and MBCAS Notification and Attestation Processes document. To further support implementation of the September 23 changes to MPCAS, the Central Bank has also updated our website information on MPCAS and included a number of new and updated documents on our website. These are set out on the slide, but namely, these include the MPCAS attestation questionnaire, the new MBCAS notification form, which comprises both the notification to us and the confirmations, and an updated MPCAS application form and application process document. Finally, to mention, the further detail can be found on the Central Bank website in the Applying for Approvals section of the credit unions area. And at this point, I'd like to thank you for your attention and hand over to David Keelty and Eamon Clark for the questions and answers section and the concluding remarks section of the seminar. Thank you.